Up until now, we've been doing CVP analysis as if the world did not change, but we know that's not true. Changes out of our control happen all the time. What if the county decides to increase property taxes? Or what if there's a typhoon in Asia and the cost of rice goes up? Well, we can evaluate the effects of many common changes on the break-even point and the potential profitability for our business. Many factors, like an increase in property taxes or an increase in management salaries, will cause an increase in fixed costs. If all other factors remain constant, an increase in fixed costs will always increase the number of units needed to break even. Obviously, the number of units needed to reach a target income will increase as well. Assume that we need to analyze the effect on profits if fixed costs for Rawhide Corporation increase from $63,000 to $81,000. How many more baseball gloves must be sold to maintain Rawhide's income goal of $36,000? Again, using our CVP equation, we can quickly see the ramifications of this change in fixed cost. Because of the added fixed costs, Rawhide must now sell 1,300 baseball gloves instead of 1,100 to earn a target income of $36,000. The computations are quite simple. Like an increase in fixed costs, an increase in the variable cost rate also increases the number of units needed to break even or to reach a target income level when all other factors remain constant. Suppose that the variable cost rate increased from $110 per baseball glove to $134 per baseball glove because of higher wages for factory personnel, increased costs of direct materials, or other factors. How does this cost increase affect the number of gloves needed to reach the target income, assuming that fixed costs are again $63,000? The increase in the variable cost rate reduces the unit contribution margin from $90 to $66, which means that more gloves must be sold to maintain the same target income. With a unit contribution of $90, the company would make $36,000 target net income by selling 1,100 baseball units. With a unit contribution margin of only $66, an additional 400 gloves must be sold to earn a target income of at least $36,000. If all other variables remain constant, an increase in the sales price decreases the sales volume needed to reach a target income. This is because an increase in sales price increases the contribution margin per baseball glove, thereby decreasing the number of gloves that must be sold to earn the same amount of target income. Assume that the demand for baseball gloves is overwhelming and that Rawhide cannot produce gloves fast enough. Hence, a decision is made to increase the price from $200 to $230 per glove. With the sales price increase of $30 per glove, the contribution margin also increases $30 per glove to $120. And with a $120 contribution margin per glove, only 825 gloves need to be sold to reach the $36,000 target income. As a result of the price increase, the number of gloves that must be sold to reach the target income decreases. Obviously, a decrease in the sales price would have the opposite effect. It would increase the number of units needed to reach the target income. Thus far, we have examined changes in only one variable at a time. However, if you work in actual business organizations, you will find that individual changes are quite rare. More often, a decision will affect several variables all at the same time. For example, should Rawhide Corporation increase fixed advertising costs by $20,000 and reduce the sales price by 10% if the result would increase sales volume by 500 units? Our analysis shows that target income would drop by $7,000 as a result of these changes, so the decision should be to not implement the proposed changes. Consider another possible decision. Should Rawhide automate part of its production? It would reduce its variable cost by $10 down to $100 per unit and increase its fixed costs up to $68,000. The resulting target income is computed here. This analysis shows that implementing those proposed changes would be beneficial because they would increase target income by $6,000. Obviously, this is true only if the assumptions can be relied on. That is, if fixed costs will rise by no more than $5,000 and unit variable costs will decrease by a full $10 per unit. Don't forget that making CVP calculations is the easy part of managing an organization. It takes an excellent manager to successfully implement the results of CVP analysis into a real business process.